On this episode of Pennies Going in Raw, it's us versus the suits. And we have the suits with us.
Hey, yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're on 4%, baby.
No way.
4 fucking percent.
Buy the fucking dip.
Hey, who told me about IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies. The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
Time to think big.
Pennies Going in Raw.
Featuring Dan, Deity at Dips, and Hugh Honey.
Produced by Vinny Strokes, baby.
Welcome back to another episode of Pennies Going in Raw. This episode of Pennies Going in Raw is brought to you by Benzinga. Benzinga was started with the mission of leveling the playing field between Wall Street and the individual investor. They want to be the #1 news source for investors, so tell them how to improve by emailing editorial@benzinga.com. Also, check out Benzinga Pro free for 2 weeks at pro.benzinga.com, the source for real-time news and data. Hey guys, thanks for tuning in to another Pennies Going in Raw. Today is Wednesday, February the 3rd, and we have a couple special guests today. And of course, the usual suspects, Hugh Henny and Dip Deity. But today we have on Douglas Boneparth, friend of the program. Doug became one of the youngest certified financial professionals in the country. In 2016, he was named to the Investment News Top 40 Under 40 and to the CNBC's Digital Financial Advisory Council in 2018. All right. Well, today we have author, financial advisor, and Twitter wise guy, Doug Boneparth. How are you, man?
I'm great. How are you guys doing?
Fantastic. We're happy to have you on.
You missed habitual envelope pusher, but wise guys.
Yeah, I mean, either way. I mean, everyone's got an envelope to push, but
right.
You know, that's why you're here. So I guess to kind of get started, could you kind of tell us what kind of started your interest in all of this and how you use that to eventually become this guy that's just beloved by young investors?
Well, I grew up in it. So my father, I'm a second generation certified financial planner.
Oh, you were born to do this.
Yeah, I was bribed into it.
Sold your soul.
Yeah. No, my dad saw me having way too much fun in college, and he's like, if we don't get this kid some real skills, you know, I go south quick. So he challenged me a little bit, and I was taking exams and licenses, and 17 years later, here we are now running a wealth management firm primarily for millennials. I guess that's the thing that's very different. So it's just been 17 years of it. That look, how many 36-year-olds are out there with like 17 years of real experience? So
that's crazy when you say 17 years. And I'm looking at you and I'm like, it doesn't add up. I'm like, wow, you and Hugh have both been doing this since you were 14.
Yeah. So. That's the funny thing is like to be able to see where we, like this environment now where, obviously younger people are getting interested in not just trading and investing in the market, but personal finance in general. Like I'm blown away week in and week out with, all the veins of money and finance that are popping up here. It's crazy to see. And obviously stumbling across the two of you, there it is.
Yeah, I think just because of the amount of resources that are out, I mean, everyone's using YouTube. The algorithm really picks up on those like Graham Stephan videos. And then, you see the thumbnails and it's like turned into $100,000. Like I'm 28 years old and I have 3 revenue streams making $30,000 a month and stuff like that.
Yeah, we BuzzFeeded the thing, Yeah. Cool captions, clickbaitery, all of that. And depending on which rabbit hole you go down, you might come out of that with a tremendous amount of knowledge and, maybe some passion or desire to go.
Or you may just end up with an Acorn account.
or you may end up with a margin call.
Yeah.
So I think one thing that really got me interested, and I think this will touch for both of you guys. You guys both love Roth IRAs. Big Roth IRA guys.
Huge.
I want to both like hear you guys kind of what would you stress? Because we've hit on it a bunch. For anyone that's listened to the podcast and hasn't made one, what would you say to them? What are they missing?
Well, I'll be very objective with my feelings towards the Roth. And it's interesting that, younger people like the Roth over pre-tax dollars going into traditional or their 401k. And I guess maybe it's just because I was trained this way. Like we always called it the tax triangle, right? You had your tax-free, tax-deferred, and taxable accounts. And the goal always was to have a decent balance of these three things because of uncertainty. Like we don't know where tax rates are in the future, and you don't know where your what your taxable income is going to be in the future. So you got this big kind of future question mark. And we tend to do this thing where depending on what administration or tax regime we're in, you blow hot and cold on which one's the better dollar to put in. And at the end of the day, you're still guessing. Like your crystal ball's as good as mine as far as like what tax rates are going to be and what your taxable income is going to be. So we're always trained to balance these things out. But that doesn't mean I don't like it or like it any more or less than any other strategy. I always look at things with an individualistic lens on who I'm talking about. Like if you can definitively say to me, I'm going to live a lifestyle far less than the amount of money I'm earning and spending now during my working years, well, you might want that deduction today, right? Despite not knowing where where tax rates are going to be in the future. And you can play this game all day long. But there's something very appealing to Roth dollars that come out tax-free. There's something very appealing to the, mega backdoor strategies that pop up, and are becoming more and more popular where you can get loads of money. And that's like the only way you can really do that unless you're running your own business and you can do 401k with profit sharing plan and get into like the nitty gritty new comparability plans and really start like figuring out ways to put beyond just, $59,000 away and get up into like six-figure stuff. So little diatribe there.
Yeah, definitely. Yeah. And I think the reason that I personally like it the most is because I'm always striving for, I'm always trying to create like, extra revenue streams to where, my tax bracket for when I retire is, let's call it 30, 40, depending what, obviously, as you were saying, what administration is in and what we're looking at. So that's kind of why I've always gone towards it. But something else that I wanted to hear your thoughts on was kind of the Roth versus like an HSA. Like kind of what are your thoughts about that? And again, if you're okay with it, using the example that, we're striving for a higher income as we retire, for a revenue stream, because I know that, obviously it's, it depends per person and something like that, or you can give your thoughts on both. If I want to get to 59, call it quits and never make another, another taxable dollar.
Yeah, no, you bring up great points there. And I think that's what's gravitating people towards the Roth option is you can get principal out, penalty free. So if you're retiring early, you're not beholden to 59 and a half to get your money and, get hit with a penalty. That's a great point, right? HSAs versus Roth. I mean, I view the HSA as like that other little secret way to sock money away, right? I would tend to see people max out their 401ks, whether that's pre-tax or post-tax dollars, depending on which flavor you want to go with. Do your Roth conversion if possible, then hit up the HSA. And it's funny, I was actually thinking about like HSA today and like this notion that we can use it as we were aligned there. It was like who the amount of people who should be using this or do use it for actual medical expenses like throughout the year versus like actually using it as a long-term, tax deferred investment strategy as, for retirement.
I would love to see the statistics on that because I'm sure the only people that I've talked to about
don't exist.
yeah. Maybe like 1% just, claim, because they think they'll get in trouble or something. Yeah. Okay. So those are really good points for sure.
And the other thing I think you said that, again, tilts towards Roth and another reason to like it so much. And I'm drawing a blank real quick. We talked about, getting the money out, tax-free growth. There was a really good one I had here I know what it was. it's that with all the money we're printing, kind of this notion that, well, we're going to have to raise tax rates, kind of convincing yourself that the future only holds higher tax rates, and to like really stop debating what's going to be 10, 20, 30 plus years out just based on what we're currently doing today. There's a fair argument there. But a lot of people like to deal. Interestingly enough, when I work with all my clients, a lot of my clients who work in finance or banking, and I ask them Roth first, post-tax versus pre-tax, a lot of people just draw the line in the sand as, I want to be able to bank on what I know today, and $1 pre-tax is $1 savings now, and I'll take that. And also they're earning, they're and they're in New York City, so you're making a lot of money in New York City as a W-2 employee who rents, right? Yeah. Like, what arrows do you have in your quiver to shoot at the tax bill, unless you got a side business or you're accumulating real estate or finding other ways to actively generate money or actively lose money to offset that income. Maybe you'll create the phantom income, right? There's not many ways to really do that. So that's another point for Roth. Yeah, no, that's definitely, I know, like me personally, I always, I'm way more of a fan of what I know today, kind of is what you were saying. Because I mean, we could even touch on, Social Security. What do you think by the time that even you are ready to collect that you will have Social Security? Get out of my head, man. Seriously. So what we do, since we cater to mostly, mid to older millennials, that question comes up a lot. Like, can we rely on Social Security being there? So when we're running the, financial independence or retirement planning scenarios, that's the opportunity to mess with that variable. And almost categorically across that type of client, we will show 50% reduction and 100% reduction in the current system. So, we see what benefits would be. And my opinion personally, other than because it comes up a lot, we want to answer the client's questions. I think we'll have it. And I don't think it will be, as we know it today. It's hard to predict what specifically that change would be. I think a 50 to 100% cut, as I'm illustrating in the planning work, it's pretty drastic, right? Yeah. I mean, what they've tend to have done over, recent history is just push out full retirement age. So we're at 67 now. We're going to, and then that, we're going to live longer. So let's make it 71 and we can keep doing that. Good thing about US though, is unlike other countries, we have a lot of young people in the workforce and still entering the workforce. So when you think about a system that's, funded through payroll here, there's an argument to be made that, we're not spending down this program, tomorrow. But yes, it is a concern. That's how we address it. And I think it will look different by the time we get there. That's now 30 years away. It's a long time.
That's a long time. Yeah, but I'm already thinking about that, I'm ready for my Florida home, sipping margaritas, me and Dan, 2 armrests, 2 old men,
Listen, I grew up in South Florida. I grew up in Boca Raton, Florida. What you're describing was my childhood. And I moved to New York and I was like, everyone jokes, you did that backwards. Like my parents were the New Yorkers who moved down to South Florida. And, their knucklehead kid moves back to the Northeast to the cold. So no one really understands that. Yeah.
Well, it's funny. Dan sent me a thing today about James Harden being, traded. Mm-hmm. And Dan, what was the number? It was
he's getting taxed $13 million more because he's going to be in New York now.
Yeah,
instead of Texas.
That's right. Yeah, it's a killer.
Yeah. That's a killer. And even for me, I mean, I'm on the other side in Jersey. And I mean, really, when I was deciding where I wanted to live, it really came down to that New York City tax. That's really, I mean, that's for, I'm obviously self-employed. Yep. My capital gains is at, the highest rate. So that few percentage points makes a huge difference.
Of course. Yeah. I've yet to meet a client that wants to spend more in tax than they have to. And I'm pretty sure I will not meet that person. Be a weird.
That's a true patriot right there. That's a true patriot. Yeah.
Follow the rules and save yourself taxes. I was just talking to a friend before this and, he gets paid. He smart guy. doesn't even know if he's a W-2 or 1099, making a ton of money, no benefits, nothing. And I'm like, are you being paid as a W-2? And he's like, literally, I get cash. That's it. No benefits, nothing. I'm like, so why aren't you being paid as a 1099? And if possible, do that. I'm like, I can save you $60,000 in taxes just thinking about legitimate business deductions from home office to transportation. Like, it's like I never really thought about that. All I do is, think about tech and software and, what I do. And that goes to show, like, you can make all this, you can be so smart, make all this money, and you don't even need to be the one filling out your taxes or doing your bookkeeping. You just need to be aware. You just need to be aware that these things exist and go seek them and put money back in your pocket. It's wild. It doesn't surprise me anymore, but here we are.
Yeah, there are just so many avenues of saving money, especially when it comes to your taxes. But I think one thing a lot of our listeners would love to hear about right now is going on. It's happening today. It's happening this week. The SPAC attack. SPACs are everywhere.
Everywhere.
What are your thoughts on them? How are you feeling?
Things that happen at the top.
We're actually thinking of getting a SPAC for the podcast, PGIR. What are you thinking? You like it?
I mean, what are you going to debut at?
Well, I want to be a billionaire, so probably whatever that cost, like 500,000 a share or something like that. Who knows?
It's going to be interesting to see how this plays out. There's a big part of me that says only so few will be successful. Think about like venture capital for a second, right? Like, you got to do how many deals to get one, and that one that wins better be so big that it mitigates all the losers that you just invested in. There's a big part of that mentality that I think about with SPACs. Who is truly going to be the winner here? Which one are going to be? It's going to be hard to do that. You got so much cash being thrown at stuff. It doesn't necessarily speak loudly for transparency. And that's tough. It's tough to navigate. How much is hype versus how much is actually the purchase of, companies that are going to make it, and there are things that are happening. I mean, what's in a name, right? It really depends on the assets you're buying, but like there's already so many jokes and memes and funny names to these things. Maybe that means nothing, but perhaps it means a lot in terms of where we are in a market cycle.
You're a hater? You're a SPAC hater?
No, not at all. I mean,
okay, good.
I rarely, I might tweet something that seems like I hate one thing or another. I'll be very direct with what I do and don't like, person to person. I want anyone who is serious about investing to make money.
It's tough whenever you're tweeting on side, even if you tweet both sides. Right. Not a lot of people are only going to see one tweet. You can and they
don't even see the follow up where you're like clarifying if you did something really spicy.
That's the worst.
It's so tough. It is. Yeah. Well, how do you go ahead?
No, the only thing I was going to say was that I think it's kind of one of my favorite movies is China Hustle. And it goes back to, the reverse mergers and things of that nature. And what we kind of talked about last week on the podcast was that I think right now of the SPACs that we're seeing, we saw the amount of SPACs from last year to this year double. And I think that we're going to see that trend continue because now that we have, I saw a statistic the other day, 25% more money is in the market from the beginning of 2020. Okay. If we take the amount of time, the United States has been the United States, that's equal to like 49 years, the interest and other things, like 49 years of money being thrown at the market in one single year.
Yeah.
And kind of, go ahead. No, go ahead.
2020 had 83.4 billion raised on 248 IPOs with an average size of 336 million. Want to know what 2019 was?
What?
13.6 billion, 59. I mean, average size is up a third. Number of IPOs themselves up, 4 to 5x. Amount raised up, stupid.
Yeah.
And already this year, I'm trying to check where this is being marked. It's probably pretty recent. It's only 14 days in the year. We're already at 11.7 billion on 43 IPOs, and we're not even halfway through January. So what you're saying, checks out real well here. It's gonna get nuts. It's gonna get nuts, and therefore, how many of them are gonna win? There you go. So how many are really gonna be the winners? And it's only gonna make it harder. It's not going to make it easier. It's going to make it easier to throw your money at it. It's going to make it harder to make money on it.
Exactly. And we're seeing some of these SPACs just get flown up $13, $14 range without even, talking about a possible, partner. And then I think that's what we're going to see is maybe not this year, but as smart money as we see more money, especially, I don't want to put this out there, but kind of what we saw with the reverse mergers, as we see slick money, money that's not doing it for the right reasons, just to make a quick buck, as we see that, and then we see the share structure come out, and the share structure is complete nonsense.
Unbelievable. Like the costs here are, I mean, that's the thing, right? Like in my world where, it'll be, I don't know when I would be offering, or soliciting SPACs to clients, it'd probably be the other way around. Or like, should I do this? We can talk about that. It reminds me of sometimes these folks out there offering, I wouldn't go as far as it reminds me of the VUL and VA space a little bit, where you look at the cost structures or non-traded products, like non-traded REITs, or even some crypto, products where these are dirty ways of going about owning something that if you either, directly held it or had enough capital to buy in yourself, you would save yourself a ridiculous amount in fee because that's how they're structuring these things. So, but it's easy. I think it's also easy to pick these things apart and look at the downsides. And then you have just the other day, Sofi, right? Yeah. As someone who's been following that company for so long, I'm happy for the employees that have stuck it out. They had the controversy with their CEO years back before Noto left Twitter and came over there and said, we're not going public. I mean, imagine working there for 5-6 years. You think you're going IPO next week, and then you're told that's off the table indefinitely. Can you imagine the talent that went out the door after waiting that long?
I have no words because it just gets to a point to where it's and then inside your mind, you're like, what am I doing this for?
Yeah. And now, ironically, Chamath comes in, he's going to buy it. And he's the loudest and most,
talk about Twitter personality.
Oh, he's killing it. I love it. I mean, talk about taking the right marketing approach. Whatever your opinions are on SPACs, you have to give credit there. And at the end of the day, the market's going to determine how good of an allocator you were. Don't talk smack one way or the other when the market's going to tell you if you were right or wrong. You can just wait, just wait, or if you have a strong feeling, put up the bucks.
Yeah, it's like when people are like, "Yeah, bet me if this goes up." You are betting. I mean, you're investing in it. That's exactly what's happening right now.
All good. It's all good, homie. You got money on the line. You've spoken.
Yeah.
You've spoken.
We were just talking about, I'm in spy puts right now for a little longer day, maybe 3 weeks out. Dan and I were just talking about, man, I'm feeling like I'm eating my words right now.
I was asked a lot at the end of the year, what do you think from media outlets to clients to friends and everyone, what do you think paint a picture of 2021 for me. It's fantastic. Here I am, just like any major institution, obviously going to get any price target wrong, off the bat. I'll revise it 30 times. And the point is don't do it. But I can paint, I kind of, day in and day out thinking about what this year could look like. And I find myself painting a more of a bull case than I do a bear case. And it's hard to come out of a year like 2020 and not have your brain completely distorted in terms of how you view the markets right now. But at the same time, Are you really going to, at the end of the day, are you really going to fight the tape? Are you going to fight, another 2 trillion in stimulus that might be coming down the pipe, 0 interest rates?
Yeah.
I mean, music will eventually, listen, we break them, we fix them, that is yet to be not true.
Yeah.
It's just
that's a really good point.
So
I know we were just touching on Chamath and his Twitter. I think by the end of January there should be a ranking list of some of his best tweets, from the "fuck you, Peter" to what was the other one? Is your blue check mark for being a moron?
Oh my god, was that to Ross? Yeah, and then to Chef. There should be like a coffee table book.
Crazy.
Get at like Urban Outfitters or something like Chamath's tweets.
I guess when you have that amount of money, you can say whatever you want. I mean,
not only that, but putting your money where your mouth is.
Yeah, every time.
Again, like I'm going to do this and now I'm going to talk about it, as opposed to I'm going to talk about it and never do anything. So there you go.
See, I do go a little, and this is me being totally pessimistic and maybe a little jealous out on hundreds of millions. But at the same time, this is one of those things where, people see Chamath, and I think that he has the best intentions, and I think he is a huge innovator. But I think that part of the issue with the SPACs is that we're going to get to a point to where people with hundreds of millions who do not have the right intentions are going to come out here and say, hey, listen, we're going to take X, Y, and Z to the moon. This is going to be the innovation. And then we're going to be, leave investors inside the wind. And I think that that's one of the biggest worries for me as a SPAC, investor. I have a roommate, and he's like, there's no risk. There's no risk here. And to a certain, yeah. And on let's call it Clover and some of the ones that I think ACAM, some of the ones that I truly believe in, to a certain extent, yeah, it's great. You're getting in like an IPO level. For others, which I think we'll start to see, maybe not this year, but the following year, I think that's where we start getting into some trouble.
I think it is inevitable that there will be bad actors, that there will be scams and schemes. Why? Because that's been happening for hundreds and hundreds of years, regardless of what wrapper, what window dressing, no matter how you frame it, that will continue to happen. And you hope it doesn't. You don't want good people getting hurt, but inevitably, that kind of money will flow into something ridiculous and people will get hurt. And, the cycle repeats itself. Regulation comes in. If it's not a SPAC, it's, whack. Who knows what's next after this? We're young. You're going to see how many more versions of something, Oh,
yeah.
And you're changing accredited investor rules, private markets becoming the new public markets. This is a tale as old as time. And, you're right. You're 100% right on that. And you'll see that to be the case. What's interesting to me is that, somewhere along the way in tops, in greed, in, overextension of markets or cycles, there almost seems to be people forget to do due diligence. People forget that they can actually do real research on, who's the allocator, what's their track record. All right, let's go further. They're eyeing what company? Let me go get what publicly available information there is on that firm. All right. Yeah. And then go with your gut in terms of how you feel about it, or if you want to do fundamentals or, think about trends, you can apply that layer to it. They're just making it so easy. It's what we do. It's not they. It's what we do. We make it so easy to throw your money at something with a lure, right? And because that's how you get the Theranoses of the world. Right?
If you haven't tweeted, if it's not a SPAC, it's whack yet, I'm taking that one.
just hat tip me and it's good.
All right, gotcha, man.
Yeah, you touched on regulation. Something that we talk a lot about is Bitcoin.
Mm-hmm.
2 questions. Are you invested in Bitcoin? What do you see as the future for Bitcoin? Whether that be price target, regulation, or do you see it as the new currency of the world?
I love these questions. First one, yes, I'm invested in Bitcoin.
Heavily compared to your portfolio?
Yes.
Whoa!
Yeah.
Yeah, get the breaking news.
Yeah, I've been public about it. And I even written an article in 2017, the first go around on the first ramp up. I wrote that article for CNBC. It was One Financial Advisor's Bitcoin Journey. So my basis is zero because I mined Bitcoin back in 2014. On the this is a cool story. I got a phone call from my zany neuroscientist friend from childhood. That's like a PhD in neurobiology. You can't have a normal conversation with him. No, you can't. You just gonna stare at him and be like, let's go get a beer. You can keep talking, but like I have no idea what you're talking about. All I heard
listening to you two talk finance. I'm like, right, yeah, yep.
So he calls me up. I think I just got back from my honeymoon, and we're depleted on cash because we just had a grand old time in Italy. And he's on the phone talking about blockchains and bitcoins and internet space money. And I have no idea. I can't even follow. But I've been doing sales long enough to know when someone's about to hit you up for money. And it just reeked of that. I'm like, how much do you want? What, you want to buy this computer that does this mining? Like, what is it? He's like, we're going to do $3,000 each to go buy a $6,000 2 terahash miner. And I'll set it up. You're GP, you're the limited partner. I'll be GP. I'll set it up. I'll mine it. I'll drop, anything we mine together in equally in our digital wallets. And let's just have some fun with this. I was like, I got to get him off the phone. I'm not cutting a check for $3,000. And the way you do that is, you holler at your wife and you say, hey, my friend's asking for $3,000 because she's going to just be like, not like that's the easiest way off the phone. She goes, oh, he's on the phone? The genius guy? Yeah, cut him the check. And I was like, oh no, that backfired. Wired him the money the next day. He said it. We went to visit him in Austin. And he took us to believe it or not, the miner manufacturer was in some small office park somewhere in Austin, Texas. And he brings us there. They're shocked we're even there. He's grilling them questions like, when are we taking receipt of this thing? Long story short, we pluck out a pretty nice amount of Bitcoins each. 2014. I guess my basis is 3K, basically zero. Wow. And I've sat on them the entire time. I've been through every drawdown since 2014. Every ramp up, you name it, I've been holding.
Wow.
Puts me in a unique position. And I'll get into like the other questions. Number one, if this thing turns out to be a giant Ponzi scheme or some kind, if like Satoshi pops out of nowhere and he's like, gotcha, like, dude, best, most amazing grift since Bernie Madoff. Congratulations. Like, people are going to lose it. I'm playing with house money from day one. Like, I will have the funniest jokes, the craziest memes, and I will have my way with it. And I will never forget the journey that I was on. I'll think about a lot of money I could have cashed out on, but it's not changing. It's not changing at least it's not changing my life yet. Right.
Yeah.
It's a very privileged position to be in, in parallel to someone who's levering themselves or taking their student loans and buying Bitcoin here at 30, 40K. Like, you better be right. About this, because that's nuts. That's scary. And I hope it does. I really hope it doesn't, I hope it works out for you. Anyways, if it goes to the moon, I'm going to laugh again. I'm going to laugh all the way to the bank. Right.
Yeah.
Right. Can you imagine the silly decision back in 2014 is putting me in a position where like I can maybe achieve financial independence a little bit faster than, I wanted to or could? That's amazing too. I win either way. So that's how I ended up with a disproportionate amount of Bitcoin than I ever thought I would have. Right.
So it sounds like your wife has the best ROI of the household right now.
And it doesn't stop there. She is the best in the house. I'm comfortable in my own abilities to tell you. I mean, we're talking like Peloton at 29.
Why do we have you on then?
It's a good question. She's funnier, smarter, better looking. She's everything I'm not. She says I'm the face. She's the brains for sure. Well, I don't know why you have me on, because she doesn't work in finance. She's an attorney.
Doesn't have her CFP. And for anyone that doesn't know, okay, I took some of my licenses for certified financial planner. I mean, that is tough. What is it? It's how many tests in total? It's 9.
You got 6 modules you need to pass before a comprehensive. I mean, here, like the comparison's always CFA versus CFP, and they're just a banana and a pear. Like they're two totally different things. If you want to do, research or be a PM or dive into valuation, CFA is for you. It's much, much harder. CFP is about breadth, right? And obviously squarely personal finance. So I don't think you get really too crazy deep into any one area. There is some depth depending on which section you're talking about, but the breadth of knowledge that's what's intimidating about it, is you just need to know so much, not deep, just so broad. And it's cool, I guess. Anyways, there's a nice distinction between the two.
Yeah. Well, I mean, touching on that, you do, you're the millennial financial planner. If I came to you and I said, Doug, I have $4,000 and $10,000 in student loans, because that is, we get a lot of DMs where a lot of our followers are inside the similar situation. Could you do anything for our followers who are inside a situation where $4,000, let's call it 30,000 in student loans, which would be a shock to me because that's quite low, but let's give you that.
Yeah. I think the average student loan stack for a graduate as of a year or two ago is like $36,000. My wife and I, wrote about this in our book 3 years ago, The Millennial Money Fix, because she went to law school and took out $300,000 in student loans. I took out another 120 to go to business school. We've refinanced it all and invested in ourselves. Well, that could have gone very wrong because of 2008 and 2009. Like when she graduated from law school, that was the impetus to start the entire practice and go down the road. Like my practice is legitimately built on millennials getting blown up in 08 and 09 on this notion that, just take out the debt, go educate yourself. There'll be a job waiting for you. And if you're becoming a lawyer, even if you hate it, you'll go work at a big firm or make enough money to pay off your loans. And then you can go do whatever you want to do. Well, obviously that just got blasted to smithereens. Now you're making you're lucky to get half of what you made. So I've been digging our own household clients out of, you said 3,000-4,000.
Yeah. We
can certainly help with that. What about $100,000, $200,000, $300,000, $400,000 in loans? And yes, these are doctors, lawyers, financiers. So it's all relative, right? That debt load is relative to earning power and your ability to get yourself out of it. It's when you come across the $130,000 in loans and all I can get is a $35,000 job. There's a legitimate, there's some problem solving that there's sacrifices that need to be made. There's a way out. And sometimes these cases really break your heart, but I'm not convinced that you just give up and stop pursuing the great things in life. I'll see to it. I've done plenty of pro bono work along those lines. So for anyone listening in that category, don't let $3,000, $4,000, $40,000 in student loan debt ever make you think that you can't go after the things that you want for yourself.
Yeah. And then I guess my last question is, there's obviously a lot more money to be made. If you went more high net worth, and I'm sure, you don't just, you say if you're older than 22, you can't be, you can't be one of our clients. But why do you try and help the millennials so much? Because even on Twitter, even though, Dan touched on it, that you do like to joke around a lot, a lot of it, it's really good information that, towards millennials. So you could go and for the high net worth client, why do you try and help the millennials so much? I guess it's my last question.
It's the best question. So I was sitting in business school about halfway through, my venture there. And the problem I had to solve the entire time was how was I going to grow a wealth management practice 20, 30 years into the future? When everyone is telling you, follow the money, get the rollovers, pre-retirees, post-retirees. And remember, I grew up doing this. That's how I started for a decade, whether it was working with my dad, which only lasted 3-4 years, or a couple senior advisors as I, was growing in New York City. And then I just watched 08, 09, deal a blow to my friends and my loved ones that, it's like, we're the smart, these are smart kids. These are the smartest of the group. And now we got one hand tied behind our back. And if I was a betting man, I would say we get over the hurdle and we still find our way to success. but I just became obsessed with how this happened, why it happened, what could we do to prevent it? How can I help right now? I had the knowledge and skill set to actually help my peers in that classroom and my friends around me. And, look, we're at that point, we're in our mid-20s. Like you're talking about an industry that's manage money so you can create revenue, right? Well, there's no money to manage. So financial planning and advice became like the value generator. But back then it was for free, like give it away for free. Basically what I was doing was investing in all of them and playing the longest game that I could. Like, let's just create the content for free. Let's continue to attract accounts with, they'll be the seed funding. Like continue doing what you're doing. You can get some big accounts here and there. But my heart and passion was helping my peers. And I knew if I did it right, that 10 years down the line, I would have a practice that was pretty much built out of, now I'm 36. So we're 36-year-old. We got the home purchases done. The kids are here. Now all our money earning is ahead of us. Everyone's making great money. Again, very highly educated. All that leverage they took to educate themselves is finally paying off. And I get to grow with them. And we're all busy. So market crashes, no one's really calling. My time is still like here to grow, right? You definitely got to service them well. You got to pick up the phone when they call, but no one's like worried about their retirement when it's 20, 30 years down the road. So it created this long game that thank God I chose to play it, because now, it's over the last 2-3 years, it's been off to the races.
That's awesome. Yeah. Well, listen, Doug, we really enjoyed this. You have your own podcast, correct?
Right. My wife and I do our own podcast. It's called We Should Be Sleeping.
We Should Be Sleeping.
Yeah.
Anything you want to pump or promote, right now's the time.
Awesome.
Guys, Doug is awesome. We've really enjoyed ourselves. Doug, you have so many, your book, right?
You got the Millennial Money Fix if you're interested in just like a nice step-by-step guide of getting from like your 20s into your like 30s and 40s. Right. This is laying the foundation. If you want to know how millennials got screwed over with student loan debt, there's a cool story in there too of just how we got in that position. The podcast, We Should Be Sleeping, if you want to hear into the minds of, a couple mid 30-something year olds who can't seem to find a minute to relax. And when they do choose to, go down some other project, like creating a podcast or writing a book, when they got 2 little kids running around and running businesses and all that kind of craziness. We had some great guests already this season, from Morgan Housel all the way to Anthony Pompliano, great founders and entrepreneurs. So we're bringing in some real good friends and guests of ours that I think you'll like, and more to come. And then just Twitter for the laughs, man. Like that's stand-up comedy to me, at Doug Boneparth. You guys have been nice to like and share some stuff, but that's as much for, the people who follow as it is for me. It's just a way to kind of get stresses of the day out there in joke form.
All right. Well, thank you so much for coming on. We'll give you a tag on Twitter. So every one of our followers will go follow you. I'm sure you'll get like 80,000 more.
You guys are killing it, man. Killing it. You'll be between the two of you at 1 million in no time.
Oh yeah. We just feed off of Zach, just getting more.
Yeah.
All right, man. Well, you take care. Have a good one. Thanks again.
Sure, guys.
Thanks, Doug.
We also have on Sahm of Carousdale Capital, the infamous hedge fund known for shorting all of FinTwit's fund plays. Enjoy. All right, guys. So today we have on Sahm Adrangi, the head of Carousdale Capital, infamous Carousdale Capital. Thank you for joining us, man.
Sure.
A very bold time for you to join us, and this is more of on Hugh's side. So I'll let him kind of take the reins of this interview. So please go ahead.
Sure.
Yeah. So just getting into your background a little bit, I was looking into it, and most of your past employment is heavy in distressed assets and restructuring. So that's kind of a far way from, shorting Fubo and Plug. And so you can tell us a little bit about how you really took that transition and a little bit behind Carousdale.
Sure. So I launched my fund 11 years ago now. So it was middle of 2009. Like I started in April 2009, launched in July 2009. I was younger at the time. I was 29, I think. 29. And my background was in distress. So I'd worked at a distress fund that peaked at like $3 billion at the peak. It was called Longacre Management. And so my background was in distress. I worked in investment banking on the restructuring side before that, and leverage finance before that. So it was all credit. But I think one of my takeaways from working in distressed is that you're always investing in bad companies. So for us on the long side, we tend to invest in quality, businesses that are going to be a lot larger 10, 20, 30 years from now. So it's just sort of not really my style to, buy deep value, buy, really garbage companies, but at like really low valuations. And you do a lot of that in distressed, right? And then just with the bull market, there's not that many distressed opportunities, right? So your universe of investable assets is a lot smaller than in equities. And then I just think it's fun. If you know what you're doing in distressed, you can make a lot of money. But the universe of investable assets is small, and equities can get pretty mispriced. So we've always done equities, and we've really not done much credit. Like even in Intelsat, which we were at a couple of years ago, which was like a real credit player for a lot of funds, we were just in the equity. We didn't have enough expertise in the capital structure to even play around in the credit, which probably would have been a better play, if you know what you're doing there.
Yeah, definitely.
So.
All right. So with that being said, a lot of our listeners were kind of wondering, is there something between you and the stock Twitter community? And are you still short on Fubo? And what are your thoughts on this whole GME situation? I know there's a packed question right there, but I think it's all kind of relevant.
Yeah. On Fubo, we wanted to go long. I mean, we're not sure right now, but the idea was if we go out and we put a video on how we're short Fubo, the thing will rip. So theoretically, we could have argued, the company's overvalued in my opinion, but you can say that you think it's overvalued, but you're long the stock because, a bunch of Reddit guys are going to try to squeeze the stock. So that was the plan. I didn't do it. I wish I'd done it. I feel like the time has passed.
Yeah, that was quite the pulling the Hesse hay. I like the idea.
It would have been great. I just got talked out of it. I'm just regretting it all weekend. Now it's up 20%.
Hey, we're crossing 50 right now.
I know. That's a sore subject for me personally, since I had this idea and I didn't act on it.
Yeah.
But yeah, for us, Twitter has been a really powerful tool. So, just a little bit on the history of short activism. Andrew Left started doing it, Citron/Shitron. He started doing it back in 2000, and for 10 years, he was the only one doing it. And then in 2010, there were all these Chinese companies that had gone public through reverse mergers that were fake. And
Hugh loves the China hustle.
Right. And we conspicuously weren't in it. I sort of forgot to respond to that director's email. But we were behind a lot of those trades, and we were involved in a lot of those trades, and sort of knew all those players, and basically had all these companies that were complete fakes. And the only way to make money off of it was to actively expose it. So that was when sort of short activism really became a thing. And we generated some returns that we could go out and market. And so we raised a fund out of it. Today we manage 700 million. That's how sort of short activism came to be. And, back then I was on Yahoo Finance. I had some Yahoo Finance handle, and we put our reports there and hope people cared. And we'd use Seeking Alpha. We turned Seeking Alpha into a site where legitimate reports were on. Before us, there was literally nothing of quality on there, I think, for the most part. And then you saw these short activists put out these, 10,000 page articles with all this detail on Chinese frauds. And you had I remember there was a group, Geo Investing. I believe it was Geo Investing. It was somebody, it might have been, I think it was Geo. But somebody did sort of a time-lapse motion photography where they were outside. They camped outside of this factory for a month. And for 28 days out of the month, there was nothing going in and out of the factory. And then one day there's all these buses coming in because there was an investor tour. So they had bussed in a bunch of Chinese villagers to make to pretend that the factory was operational. And people started posting this stuff on Seeking Alpha, and they sort of made Seeking Alpha a much more legitimate source of getting real ideas. And then Twitter was sort of mid-decade. We started our Twitter in 2013. And Andrew, back then, Andrew was mostly using a site. It wasn't really Twitter. But I think by 2015, 2016, Twitter sort of became the most powerful form of disseminating research on short activism. For us, it's definitely like we have an email list, but all we really care about is like when we sort of tweet out our ideas and stuff. And then, I think on your guys' end, a lot of the day trading community, Twitter's taken over there in terms of how people communicate.
Yeah, I don't think there's any other platform aside from maybe a Facebook group where you could really get across the information like you can on Twitter. No one's going to post on Instagram with the DD in the caption,
Yeah. I remember Herbalife was sort of the first time like people really started getting their info from Twitter. And that was 2013. That was December 2013.
Right.
And ever since then, we've been we use Twitter for ideas. It's a lot of retail guys. So
I guess given all the stuff that's happened in the past week, what are your kind of overall thoughts on this whole GameStop thing, aside from just you wanted to kind of do the whole Fubo thing, but obviously the nonsense the brokers did and just all the things that led up to what culminated in all these retail traders being super pissed off. Do you have any thoughts, or are you just with everyone else on that one?
Well, I think there's a couple things. People are pissed off at us and Citron, short activists. I think there's just a lot of fatigue around short activism. I think the short activists are sort of sick of short activism a little bit. Andrew announced that he's not doing this anymore, right? After 20 years of being the most prominent short activist, he's like, I'm not anymore. And I think it's partly because, if anybody came out with a report tomorrow, they'd be squeezed to the moon. And so, it's not really a viable strategy at this point. But I think it's just been sort of a tougher way to make money for a long time. And I think he just sort of I'm guessing he just sort of doesn't even want to do it anymore. So he sort of quit doing it. We're obviously taking a pause. I'd be curious if anybody else really comes out with reports. So I think on short activism, there's just sort of been maybe a few too many reports, right? And there's been some high quality stuff, but less high quality stuff out there as well. So I think people are trying to squeeze the shorts. This whole idea of just squeezing funds is a great way, for people to get other people to invest in the stock. I'm not sure it's really even a thing. The mechanics.
Yeah, it's it started. I don't know if that's how it. I guess the smarter people that kind of looked at it fundamentally and saw all the shorts. I think that's how it started, and then everyone on Facebook was like, "Ooh, GameStop go to 1,000." Everyone's saying so, and then it just kind of.
Yeah, it'll go to 1,000 if you build this Reddit community that's getting input from the White House, where literally everyone in the world is following it. Yeah, I think a lot of people are going to buy some GameStop stock, so it might go to 1,000. I'm not, which is incredible, right? This is one of the most incredible pyramid schemes, Ponzi schemes that has been developed in a long time, right? Where everyone gets everyone else to buy something that's not worth that thing.
Yeah, I never thought of it as a pyramid scheme. That's an interesting way of putting it.
Yeah, that's what this is, right? It's not. Originally, I think GameStop was probably a good investment, right? But
anywhere over 20, not so much.
Yeah, it's just my aunt or my cousin's wife is an artist. She makes hats, and she messaged me, following this thing. Should I be buying some Dogecoin? Dogecoin is the exact same thing. It's obviously, who's going to be left holding the bag, and this is sort of epic. And what's happening?
So far,
I'm not sure. My point was, I don't know if that really has anything to do with the short interest, right, or squeezing the shorts. I think it's more about getting other people to buy something until someone's left holding the bag. Squeezing shorts is a fun narrative.
Yeah, it's on, and then everyone wants to be a trader now. So toss that in, and here's where we are.
So far, what I got other day is that you're not going to release a short report inside the near future. Well, right now, you're not going to release a short report. You don't own any dog coin. I'm assuming, or is that not true?
I can't find the login to my Coinbase account.
And so, I mean, so it sounds like you and Andrew are pretty close, or that, being definitely that you guys work inside the same industry.
Yeah, I like Andrew a lot. I think
yeah,
legend. And
yeah, I mean, they definitely cracked. I mean, like Dan said, I'm a huge fan of China Hustle. So do you think that we're seeing, because especially with him being, doing this for 20 years, for him to shut down, saying that he's going to stop doing these reports, do you think that we're seeing a fundamental change, towards the retail sector? Or do you think that this is just a once in a blue moon, GameStop hit the fifth standard deviation and, all these people that are, just bidding up GameStop will go away? Or do you think that we are going to start seeing, kind of what you worked in, distressed assets that, could be potentially undervalued, start to really moon?
Yeah, I mean, I think the involvement in retail and investing sped up a lot last year. I mean, it's sort of been a thing for a while. It's funny as us as approach as a hedge fund. Like our investors are pretty traditional hedge fund investors. A lot of like offshore investors in Switzerland, Hong Kong, that sort of thing, right? But our marketing spiel has always been that we share our research with the public. We're active on Twitter, like. We don't take ourselves too seriously. I think anybody who reads out Twitter, right now I'm just sort of like written 3 tweets, I think, like making jokes of, was it my wife's boyfriend, which was like my favorite meme.
We were just talking about that, yeah.
on the Wall Street Bets memes. So yeah, like we don't take ourselves seriously. As seriously as other funds. We're not very private. I think one of the interesting things about the whole Melvin thing, and Melvin or Maple Lane, which are sort of, I think, the 2 funds that reportedly are down the most, is they don't really have a public persona. Those PMs, those CIOs haven't sort of come out in the public and addressed some of this dialogue, even though, they're the talk of everyone right now, right? You'd think that they would say something, right? So the hedging community has always been very secretive, and we haven't been. And I think part of it is that, when we had a Twitter account 7 years ago, it was sort of a joke, right? I mean, people were, really having difficulty getting their heads around, how a hedge fund, would have this dialogue with retail investors, right? It just sort of wasn't really a thing. And there are exceptions to the rule, like Bill Ackman's always been someone who's always engaged the public, made public presentations. He's not very secretive or private, but I think, there's no real reason to be secretive. And for us, having a brand and, doing podcasts like this and just sort of putting ourselves out there, it allows us to build a following such that when we have really good ideas, we can get other people into it, right? If no one's ever heard of you before outside of like the hedge fund investor community, let's say you have a really good long that you want to get everyone to be thinking about, you're just not going to necessarily have that audience. And I think it makes sense to sort of be proactively engaged.
Yeah, definitely.
So I think the movement is good. And I think, the retail involvement in investing is good. And it's probably, I don't think it's reversing, right?
No, definitely. Well, so, I mean, has the retail involvement inside the last week had you change any of your strategy and or any of your current positions, to not to cater to retail, but, because of this really, movement, if you will?
Yeah, I mean, I was thinking of putting out a Twitter live video where I said that some stock that I was previously short was overvalued, but that I'd gone long it because everybody was trying to squeeze shorts. So
that Fubo? Is that
Yeah, that would have been on Fubo.
Of course, it's Fubo.
And so, I've never considered doing that before. So you can say that's something new. That's the result of the developments of the past week. But yeah, I mean, I don't know if we would do anything differently. I mean, look, at the end of the day, when you're a day trader, you can get in and out of things, right? You can invest on stuff for like no real fundamental reason. When you manage like 700 million, to make things matter, you need to be building larger position sizes, right? And we can't just sort of trade in and out of things. So we can't really invest on the long side or on the short side, frankly, in something just purely because of technicals or, how they might trade. Like it's got to be sort of fundamentally rooted because you just sort of you can't build positions and unwind positions that easily. So at the end of the day, everything we own on the long side, we're not in like AMC, even if we think it's going to go bankrupt just because someone else is going to buy it. That's something you can do when you're smaller. You can't really do it when you're bigger, right?
Right.
And so we always have like a real fundamental reason that where we own most of our stuff, but writing our reports, sharing it with people, and hoping it gets sort of a retail following, can be a strategy. And I think that's what Andrew said in his video. He's going to sort of give up short activism, and he's going to be putting out more reports on things like Jumia or some of the longs that he's had over the years to try to sort of leverage his, I think it's like 300,000 Twitter followers, to get people to pay attention to some of the names that he's built on the long side.
Right. Well, I have just two more questions. I'm not sure if Hugh has more, but my first one was, assuming you were short GameStop, let's say from $30, $40,
right?
How would you have played that?
I mean, if you're following the threads on Wall Street Bets, you'd blow out. Yeah. I mean, you would sort of want to cover that position, right? I mean, like the last thing you want is to be short something and have it go up 10 times. And for us, frankly, it really hasn't happened. We've had a couple of stocks, mostly biotech, but many years ago that have gone up multiple times. But we don't, we sort of tend to manage our risk well and just understand that, shorting is very dangerous, right?
Maximum downside. Yeah.
Yeah. Maximum downside. Stocks can go up multiple times. It's been interesting to watch, some of these funds down, right? Because you sort of think to yourself, right, like what did they do wrong in terms of how they structured their portfolio? And how do we like make sure we don't do that? But if you're following the Wall Street Bet stuff, I mean, just understanding what an interesting phenomenon that is. Yeah, I mean, you shouldn't be short GameStop. You shouldn't be short GameStop because it's a global phenomenon. Like, who knows how many people are going to just sort of step up and buy some GameStop stock.
Yeah, now with partial shares too. I mean, sky's the limit.
And I mean, some people have like the cojones to withstand all that. Man, if I was down 10 times on a position, just at the very least, it's a horrible feeling.
Yeah. So you're just shaking your head. Like, what are you guys doing? Like, have you ever, I mean, I know like the hedge fund community is, not huge, it's a small world when you really break it down. So, is
there like a group me where you're like texting like, Citron, you really shit the bed here.
Yeah. Yeah. So like, have you ever have been in contact with them, and are you just like shaking your head or kind of, or kind of like, what's your thoughts? I mean, because that's I mean, they can say what they want about retail, but I mean, they're really billions and billions of dollars. Everything that you've worked on for years is just gone.
Totally. Especially when Melvin was up to 12 billion, right? Yeah. I mean, we're at 700 million, but sort of like my career dream has always been goal had been to, get to $1 billion. And then beyond that, just, get good returns. I don't care about like getting too big, but, $1 billion, sort of like the marker you always want to just sort of hit. But yeah, you like work super hard for that, and then suddenly you lose half of it, right? And it's just hard coming back from big losses on the return side, just from a marketing standpoint. There's so many hedge funds out there, and like, why would somebody invest in you if you're down 50% versus somebody else, right? So, that's just the stock market for you. It can, a lot of this stuff can disappear pretty quickly. And I'm just trying to think of, like, you see this every so often, right? Somebody just gets destroyed in one way or the other. I mean, even last year, there were probably some funds that were down hard in February, March, and then de-risked, didn't participate in the upside. And, they just ended up having a terrible year because of that, bad decision. Yeah, it's just pretty devastating.
Yeah.
When that happens, I think like as an individual investor, whatever, you lose money and then you can always make it back. But on the, when you run a fund, you've got a track record there. And once like track record gets obliterated, it's just really bad for marketing.
Yeah. From an investor standpoint, I mean, I can't even imagine their next quarter, their outflow. From an investor standpoint, can you imagine giving some money to someone who just loses 10 times the position?
Yeah. And, I think we've been trying to sort of back into exactly what happened, just to draw lessons on for ourselves. And I think what I'd heard over the weekend from someone I spoke with is just that, some of these funds were levered, right? So they're levered like 5-1. And, we're levered like 3-1. So it's not like we abhor leverage. It definitely made me want to come into the office today and degross the book a bit. But I think, they're just levered and they have, this sort of active short book. And it can be a recipe for disaster, right? And just shorting is just such a tough way to make a living, right? I know you guys short as well as go long. I think a lot of day traders do, but it's just tough for everyone, I think.
Yeah. Well, I guess the last thing we really have is we kind of touched on this in the podcast, and you saw the CEO of Robinhood say that they did what they did to protect their users and, kind of tried to go that narrative. What are your thoughts on what the brokers kind of did in these situations last week with limiting how much you can buy, et cetera? And was it right, criminal, or just, hey, you signed this user terms and services, sucks for you, you should have read it?
Yeah, I don't have much of an opinion on that. I think when it comes to institutional managers like us, we don't have those problems, right? Because
congrats.
Man.
Brokers, prime brokers. I mean, even on GME, we were able to, our brokers hit up and said that there was borrow available if we wanted to short the stock. We didn't, but that's something that's usually not available to retail investors. So I don't know. And then I think, look, it's going to be that case is definitely not closed, right? And people are going to be investigating on whether some of Robinhood's trading partners were involved in encouraging us doing some of those hauls. I just don't know anything about it. So we're sort of watching it like everybody else.
All right. So he pleads the fifth on this one, guys.
Yeah, and I just don't know. It's pretty complex.
Yeah, no, it definitely is. And I'm sure you're in a tough spot to be drawing any judgments on this one as well. But
are you looking for a position in GME one way or the other?
No, because I think on the long side, it's overvalued. And on the short side, we wouldn't want to deal with that squeeze. So, a lot of these GME, AMC, just seems dangerous.
Is there any trader inside of you that really wants to just, all right, GME, let's get it?
Not really.
No, I understand.
Really, I don't do, the only times I sort of do quicker trades are, if we like a stock and it misses earnings, it's down 20-25%, and we'll sort of try to trade that. But buying on dips is
child's play.
I do. And then if I feel like I have a good situation that takes advantage of buying the rumor, selling the news, we'll incorporate that into some trading. But watching stuff like GME, I don't know. It's just
not worth your time. Yeah.
It seems a little more like gambling than investing. When we put capital to work, we just try to sort of stack the odds against it, very much in our favor. I feel like it's hard to do with GME nowadays.
Yeah. All right. Well, that's all I had. Hugh, did you have anything else to ask?
No. This has been really fun.
This is awesome. This has been super eye-opening, and I feel like everyone will learn a lot. I certainly did, and thanks so much for joining.
Oh wait, okay. One last question. Okay. So I went over your past. I wasn't going to do this, but I went over your past trades, some of them. And have you ever kind of like what you were doing with Fubo? You were looking for a long. Were you looking for a long in some of your other past reports that you maybe were talking about the risks that you were going to take? Like I think one of them was TTCH or TC. Yeah. Can you touch on that a little bit?
Yeah, sure. No, I've never really been in a situation before where I've wanted to go long a stock. We published on Prothena, which is a biotech, where that was a drug in a phase 3 trial. once the phase 2 trial failed and it went down 80%, I think we went long that because it was close trading cash. But never anything like Fubo where, stock price is higher than what we published and I'm happy to go long it. And partly because just this whole idea of squeezing short sellers has never really been a thing in the way it has been the past week, right? So the opportunity never presented itself. And, we always felt that the stocks that we were publishing on the short side, were shorts, even when we've got the ideas wrong, right? And TTCF, Fubo has a bit more of a cult following, is a higher short interest. I think it just sort of seemed more prime for a stock that people would pick to try to squeeze short sellers than TTCF. Seems like the engagement around TTCF isn't that active. I mean, I think if you're trying to pick what stock, Redditors are going to go after next to try to squeeze short sellers, like you have to just sort of like read Twitter and read Reddit and see what people are talking about. I just think a lot of people talking about Fubo, a lot of people talking about AMC. TTCF just sort of hasn't made that cut. So.
Gotcha.
All right. Well, perfect, man. Thanks again for joining us. We've had a blast again, learned a lot. And I think we're going to drop this on Wednesday.
Cool. That sounds good. I'll promote it on my Twitter as well.
All right. Thank you.
All right. Thanks, guys.
Take care.
And now a few of my swing updates. So we speculated a little bit ago that SOAC was going to merge with Re Automotives. Re Automotives came out and said that they were going to merge with someone else just today on Wednesday, February 3rd. So for that reason, I'm going to cut a chunk of SOAC, but I really like the management team. When I dug into them, I really enjoyed their backgrounds and I really felt like they would be a great SPAC partner. So because we're in so low and our risk is so low, I think I'm down like 1% overall on my SOAC position. I'm going to keep a percentage just because I feel like they could definitely have a good partner. It might just be a longer swing. So that's what I'm feeling about SOAC. It's a bummer. I really wanted them to be with Re Automotives and all these different articles linking them and different management teams linking each other. So I really was hopeful. But again, the great thing about SPACs is that we're basically in at the low. Now we do have a new swing, and that is ANTE. That's Anthony, Natalie, Texas, Elephant. And so first and foremost is that you guys know that I don't like anything underneath a 10 mil float. But as we get into February, which is usually low float February, I'm going to play the hot hand, and I think that this one has maximum upside. One, the chart. This thing went parabolic and then it came back down a little bit, and now it's consolidating, and it looks like over 275 will cause a breakout to, a new high past that parabolic state. And I think that this is one where in a few weeks we could look back and be like, wow, I can't believe that was that low. Just a nice grinder pop, and that's, without news. With news, it would just be the jet fuel. Now, a little bit about this. They are a blockchain company, which is the reason I picked them. With Bitcoin curling back up, if you guys are inside the Atlas Discord, you know that I'm in Mara and Riot as well for a swing, but those tend to get really crowded, along with DPW. Any of the blockchain, the cult blockchain, they usually get pretty crowded, DPW, Mara, Riot. So I wanted to find something that wasn't that crowded. And this is my favorite by far. ANTE, they're a blockchain. They have a beautiful chart. And so I think that this one could be really good. Don't get slap happy, wait for the entry to get in, because again, this is a smaller float being underneath 10 million. So be smart. But I think that this one could really be $5, $6, maybe even if they get news, maybe 10. So I love this play. That's ANTE. And then finally, news literally coming out as I'm talking about it. NSPR. Now, I know that this one hasn't been moving that much, and I think I'm actually down from my average. They just came out with news that they're literally right now, they just secured a partner for intended registration and distribution of Seaguard EPS in mainland China. So again, just out at 8:30, Inspire MD secures partner for intended registration and distribution of Seaguard EPS in mainland China. So that's news 1 of 2 today. And the other news today is that Quiddy has agreed to make a $900,000 investment in Inspire MD's common stock. So I know that this one hasn't moved that much, and I know that some people were worried about reverse split and other things like that. I think I'm down, but like I said inside my original thesis, I really want this to be another NVIV, another MTNB, and I think that this one could be it. This is the first of 2 news. It's been holding support pretty well. That being said, if support breaks, I will be out of it. If the 30-day support breaks, I will be out of it, or some kind of bad news comes out, some kind of bad house comes out. But this is good news. I love seeing this because this was kind of just moseying around. We weren't seeing the volume was starting to die off a little bit. And this is great news, a $900,000 investment and a partner for registration and distribution in mainland China. Obviously, that's going to add huge revenue. This is a small market cap. I still would love to see this one, double and triple. And so that is our swing update. And just an overall, kind of market update and kind of how I view things. Like I said, low float February is usually what February is. I don't love low float February just because that's not really my game. I'm more of a swinger. But the great thing about low float February is that after it usually becomes a swinger's market. My game is not really scalping with my entire account for a few percent. That's great for some people, but that's not really my game. So I'm excited for the chance that, that swinging could be coming back, where we're taking 85% of our portfolio overnight, things like that. Because scalping really isn't my game. And so I think that that's kind of how we see it. It's following the trend, January poppers, low float February, and then the swinging market comes back. So I'll be excited if the swinging market comes back and we can start taking some serious money overnight. All right, guys, and that's going to about do it for this midweek episode. If you guys love our content, please go to Apple Podcast and give us a 5-star review. We love looking at the reviews and seeing, what you guys like. Any chance that we get, we love reading them. And then a quick shout out to our boys behind PGIR, our boy Vinny, the man, and of course, Kristen. All these guys work really, really hard so that PGIR can be what it is. We wouldn't be here without them. And then another shout out to my co-host Dano, going out to the big city LA for his first movie premiere. Hey, if you guys get a second, like I said, give us the 5 stars on Apple Podcasts, and then go on Twitter and @Dan and wish him good luck this week in LA. And then also while you're at it, @Vinny and Kristen, and thank them for all their work they do behind PGIR. I hope you guys enjoyed this midweek episode, and let's finish the week strong.